Third is the Treasury General Account, or TGA, currently at about $800 billion, which is essentially the checking account for the federal government. When the Treasury makes or receives payments, those flows affect dollar for dollar the supply of reserves or other liabilities in the system. The asset side of our ledger consists almost entirely of securities, including $4.2 trillion of U.S. Treasury securities and $2.1 trillion of government-guaranteed agency mortgage-backed securities, or MBS. When we add reserves to the system, we generally do so by purchasing Treasury securities in the open market and crediting the reserve accounts of the banks involved in the transaction with the seller. This process effectively transforms securities held by the public into reserves, but does not change the total amount of government liabilities held by the public. So, the Fed's balance sheet serves as a critical policy tool, especially when the policy rate is constrained by the effective lower bound, or ELB. When COVID-19 struck in March 2020, the economy came to a near standstill and financial markets seized up, threatening to transform a public health crisis into a severe, prolonged economic downturn. In response, we established a number of emergency liquidity facilities. Those programs, supported at the time by Congress and the administration, provided critical support to markets and were remarkably effective in restoring confidence and stability. At their peak in July 2020, loans from these facilities totaled just over $200 billion. Most of these loans conditions stabilized. That's normally the deepest and most liquid market in the world, and the bedrock of the global financial system was under extraordinary pressure and on the verge of collapse. We used large-scale purchases of securities to restore functionality to the Treasury market. Faced with unprecedented market dysfunction, the Fed purchased Treasury and agency securities at an extraordinary pace in March and April of 2020. These purchases supported the flow of credit to households and businesses and fostered more accommodative financial conditions to support the recovery of the economy when it ultimately came. This source of policy accommodation was particularly important as we had already lowered the federal funds rate close to zero and expected that it would remain there for some time. By June 2020, we slowed our purchase pace to a still substantial $120 billion per month. And in December of 2020, as the economic outlook remained highly uncertain, the FOMC said that we expected to maintain that pace of purchases until substantial further progress has been made toward the committee's maximum employment and price stability goals. That guidance provided assurance that the Fed would not prematurely withdraw support while the economic recovery remained fragile amid unprecedented conditions. And we maintained that pace of asset purchases through October 2021. By then, it had become apparent that elevated inflation was not likely to go away without a strong monetary response. At our meeting in November 2021, we announced a phase out of our purchases. And at our next meeting in December, we doubled the pace of that taper and said that asset purchases would conclude by mid-March of 2022. Over the entire period of purchases, our securities holdings increased by $4.6 trillion. So, a number of observers have raised questions, fairly enough, about the size and composition of asset purchases during the pandemic recovery. Throughout 2020 and 21, the economy continued to face significant challenges as successive waves of COVID caused widespread disruption and loss. During that tumultuous period, we continued to purchase in order to avoid a sharp, unwelcome tightening of financial conditions at a time when the economy still appeared to be highly vulnerable. Our thinking was informed by recent episodes in which signals about reducing the balance sheet had triggered significant tightening in financial conditions, and we were thinking of the events of December 2018, as well as the 2013 taper tantrum. Regarding the composition of our purchases, some have questioned the inclusion of agency MBS purchases given the strong housing market during the pandemic recovery. Outside of purchases aimed specifically at market functioning, MBS purchases are primarily intended, like our purchases of Treasury securities, to ease broader financial conditions when the policy rate is constrained by the effective lower bound. The extent to which these MBS purchases disproportionately affected housing market conditions during that period is challenging to determine. Many factors affect the mortgage market, and many factors beyond the mortgage market affect supply and demand in the broader housing market. With the clarity of hindsight, we could have, and perhaps should have, stopped asset purchases sooner. Our real-time decisions were intended to serve as insurance against downside risks. We knew that we could unwind purchases relatively quickly once we ended them, which is exactly what we did. Research and experience tell us that asset purchases affect the economy through expectations regarding the future size and duration of our balance sheet, so that when we announced our taper, market participants began pricing in its effects, pulling forward the tightening in financial conditions. Stopping sooner could have made some difference, but not likely enough to fundamentally alter the trajectory of the economy. Nonetheless, our experience since 2020 does suggest that we can be more nimble in our use of the balance sheet and more confident that our communications will foster appropriate expectations among market participants, given their growing experience with these tools. Some have also argued that we could have better explained the purpose of asset purchases in real time. There's always room for improved communication, but I believe our statements were reasonably clear about our objectives, which were to support and then sustain smooth market functioning and to help foster accommodative financial conditions. Over time, the relative importance of those objectives evolved with economic conditions, but the objectives were never in conflict. So at the time, this issue appeared to be a distinction without much of a difference. That's not always the case, of course. For example, the March 2023 banking stress led to a sizable increase in our balance sheet through lending operations. We clearly differentiated these financial stability operations from our monetary policy stance. Indeed, we continued to raise the policy rate through that time. Turning to my second topic, pardon me. Our ample reserves regime has proven highly effective, delivering good control of our policy rate across a wide range of challenging economic conditions, while promoting financial stability and supporting a resilient payment system. In this framework, an ample supply of reserves ensures adequate liquidity in the banking system, and control of our policy rate is achieved through the setting of our administered rates, interest on reserve balances, and the overnight repurchase rate. Reverse repo rate, rather. This approach allows us to maintain rate control independently of the size of our balance sheet. And that's important given large unpredictable swings in liquidity demand from the private sector and significant fluctuations in the autonomous factors affecting reserve supply, such as the TGA. This framework has proved resilient whether the balance sheet is shrinking or growing. Since June 2022, we've reduced the size of our balance sheet by $2.2 trillion, from 35% to just under 22% of GDP, while maintaining effective interest rate control. Our long-stated plan is to stop balance sheet runoff when reserves are somewhat above the level we judge consistent with ample reserves conditions. We may approach that point in coming months, and we are closely monitoring a wide range of indicators to inform this decision. Some signs have begun to emerge that liquidity conditions are gradually tightening, including a general firming of repo rates, along with more noticeable but temporary pressures on selected dates. The committee's plans lay out a deliberately cautious approach to avoid the kind of money market strains experienced in September 2019. Moreover, the tools of our implementation framework, including the standing repo facility and the discount window, will help contain funding pressures and keep the federal funds rate within our target range through this transition to lower reserve levels. Normalizing the size of our balance sheet does not mean going back to the balance sheet we had before the pandemic. In the longer run, the size of our balance sheet is determined by the public's demand for our liabilities rather than by our pandemic-related asset purchases. Non-reserve liabilities currently stand about $1.1 trillion higher than just prior to the pandemic, thus requiring that our securities holdings be equally higher. Demand for reserves has risen as well, in part reflecting the growth of the banking system and the overall economy. Regarding the composition of our securities portfolio, relative to the outstanding universe of Treasury securities, our portfolio is currently overweight longer-term securities and underweight shorter-term securities. The longer-run composition will be a topic of committee discussion. Transition to our desired composition will occur gradually and predictably, giving market participants time to adjust and minimizing the risk of market disruption. Consistent with our longstanding guidance, we aim for a portfolio consisting primarily of Treasury securities over the longer run. Some have questioned whether the interest we pay on reserves is costly to taxpayers. In fact, that is not the case. The Fed earns interest income from Treasury securities that back reserves. Most of the time, our interest earnings from Treasury holdings more than cover the interest paid on reserves, generating significant remittances to the Treasury. By law, we remit all profits to the Treasury after covering expenses. And since 2008, even after accounting for the recent period of negative net income, our total remittances to Treasury have totaled more than $900 billion. While our net interest income has temporarily been negative due to the rapid rise in policy rates to control inflation, this is highly unusual. Our net income will soon turn positive again, as it typically has been throughout our history. Of course, having negative net income has no bearing at all on our ability to conduct monetary policy or meet our financial obligations. If our ability to pay interest on reserves and other liabilities were eliminated, the Fed would lose control over rates. The stance of monetary policy would no longer be appropriately calibrated to economic conditions and would push the economy away from our employment and price stability goals. To restore rate control, large sales of securities over a short period of time would be needed to shrink our balance sheet and the quantity of reserves in the system. The volume and speed of these sales could strain Treasury market functioning and compromise financial stability. Market participants would need to absorb the sales of Treasury securities and agency MBS, which would put upward pressure on the entire yield curve, raising borrowing costs for the Treasury and private sector. Even after that volatile and disruptive process, the banking system would be less resilient and more vulnerable to liquidity shocks. The bottom line is that our ample reserves regime has proven remarkably effective for implementing monetary policy and supporting economic and financial stability. So I will close with a brief discussion of the economy and the outlook for monetary policy. Although some important government data have been delayed due to the shutdown, we routinely review a wide variety of public and private sector data that have remained available. We also maintain a nationwide network of contacts through the reserve banks who provide valuable insights, which will be summarized in tomorrow's Beige Book. Based on the data we do have, it's fair to say that the outlook for employment and inflation does not appear to have changed much since our September meeting 4 weeks ago. Data available prior to the shutdown, however, show that growth in economic activity may be on a somewhat firmer trajectory than expected. While the unemployment rate remained low through August, payroll gains have slowed sharply, likely in part due to a decline in labor force growth due to lower immigration and lower labor force participation. In this less dynamic and somewhat softer labor market, the downside risks to employment appear to have risen. While official employment data for September are delayed, available evidence suggests that both layoffs and hiring remain low, and that both households' perceptions of job availability and firms' perceptions of hiring difficulty continue their downward trajectories. Meanwhile, 12-month core PCE inflation was 2.9% in August, up slightly from earlier this year, as rising core goods inflation has outpaced continued disinflation in housing services. Available data and surveys continue to show that goods price increases primarily reflect tariffs rather than broader inflationary pressures. Consistent with these effects, near-term inflation expectations have generally increased this year, while most longer-term expectation measures remain aligned with our 2% goal. Rising downside risks to employment have shifted our assessment of the balance of risks. As a result, we judged it appropriate to take another step toward a more neutral policy stance at our September meeting. There is no risk-free path for policy as we navigate the tension between our employment and inflation goals. This challenge was evident in the dispersion of committee participants' projections at the September meeting. And I'll stress again that these projections should be understood as representing a range of potential outcomes whose probabilities evolve as new information informs our meeting-by-meeting approach to policymaking. We'll set policy based on the evolution of the economic outlook and the balance of risks rather than following a predetermined path. And with that, thank you again for this wonderful award and for inviting me here today. I look forward to our discussion. Thank you.
You need your iPad and
No, buddy.
Thank you, Chair Powell, for the excellent remarks in the Adam Smith address. And we will have about half an hour for questions. So
Sounds like a long
should
time.
have talked longer. So let me start with, before I go to some of the questions coming in from the audience, and do use the Connect app to generate those. You have said, and you repeated again here, that there are no risk-free paths for the Fed now. So in light of that, and in particular, with where the recent inflation data are running, let me group this with some of the questions that we're seeing coming in on the app as well. Obviously, always data dependent. But thinking about the dual mandate of maximum employment and price stability, how concerned are you that if the rate of pass-through of tariffs is slower, that might begin to look like more persistent inflation, as opposed to a one-time, as if the tariff adjustment came through all at once, and then it would be quite clearly a one-time price level shift?
So that's certainly a risk. As I mentioned, there really isn't a risk-free path now, since it appears that inflation is running above our target, and appears to be continuing to increase quite gradually, but increase. It's still on the way up. So there's a risk there that would lend to greater persistence. But now the labor market has demonstrated pretty significant downside risks as payroll jobs have declined, and both the supply and demand for labor has declined quite sharply. So those two states of affairs for our two goal variables, call for different monetary policy responses. So as they come more into balance, I think the idea has been that policy should move from being tight to some degree to being more neutral as those two things balance out. But it is clear, though, that if we move too quickly, then we may leave the inflation job unfinished and have to come back later and finish it. And if we move too slowly, there may be unnecessary losses, painful losses in the employment market. So we're in the difficult situation of balancing those two things. I think for the last few months, we've been able to maintain a restrictive stance because the labor market was still pretty solid. I think that the data we got right after the July meeting showed that, which adjusted back all the way through May, showed that the labor market has actually softened pretty considerably and puts us in a situation where the two risks are closer to being in balance.
Let's move to the other risk then and talk about employment a little bit. We had Anna Paulson here yesterday, and she spoke about the break-even unemployment or break-even employment growth rate. And that's a question from the audience as well. So I believe she said that it's certainly lower than it was, and the standard error around those estimates probably includes some numbers that might even be negative. Where do you see the monthly break-even employment growth rate at this point?
I'm not going to try to give you a pinpoint number, but as you pointed out, the standard error around these things is 50,000 plus or minus, something like that. And that would certainly, I think the range of plausible numbers for the break-even rate is probably does go below zero, accounting for those standard errors. It's clearly come down a great deal. And that's what's so challenging about this, is that both supply and demand in the labor market have come down so sharply, so quickly. And the fact that the unemployment rate has barely moved is kind of remarkable in and of itself, and suggests that they're moving at roughly the same pace. Although, of course, the unemployment rate has ticked up, which suggests that demand is moving a little faster than supply. I wouldn't want to point to a specific number other than to say that it's come way down. And there are many estimates out there. By the way, there are many ways to calculate it, so you're going to get different estimates.
We're certainly in a volatile and changing environment. So one question I have is whether you see any changes in the transmission mechanism of monetary policy actions. So when we speak of long and variable lags, as we do, are those changing? And in particular, do you think there might be any difference in the impacts of policy on inflation versus employment? Is one changing more than the other?
That's like 2 or 3 questions, so I might have to come back to you. That's right. So on transmission, there, in theory at least, I see 2 things. One is, what we say and what the actions that we take on monetary policy and how quickly that gets into financial markets. So if you go back to when I was in college, that part would have taken, weeks, months probably. And now that part happens essentially instantaneously. But the rest of it, once it's in the financial markets, how quickly does it affect economic activity, unemployment, employment, inflation, et cetera? I think that's more dependent on the conditions in the economy. For example, if you take the group of people who had extremely low rate mortgages, right? And even so, if you can cut rates, but they're a long way down, and they're sort of in a place where it's going to be expensive to move and to take out a much higher rate mortgage, even assuming significant numbers of cuts. So that has probably blunted the transmission of lower rates into that part of the economy. But overall, I think it still works the way we think it works, which is, long and variable lags means a lot of uncertainty about how it's being affected. I think the last part of your question, the lore has been that inflation and employment come later. The first decisions are purchasing decisions, hiring decisions, and things. Well, purchasing decisions, can be affected probably more quickly, but then those would eventually affect employment and inflation. So longer lags are when the research generally shows longer and longer lags for employment and inflation.
And I guess the variable part of that comment does give us a bit of cover.
A lot of uncertainty.
So you spoke about the adjustments or the challenges that you're facing with some government data not currently being published. Beyond the headline unemployment rate, which we're not going to see right away, what other labor market indicators are you monitoring most closely to gauge that side of the mandate?
So I think everyone's looking at the same non-government data. So there's a set of non-government data around, or non-federal government data around labor markets. For example, state level unemployment, claim reports. You can add those up and get a pretty decent estimate, and that's a really good one. There's also ADP has its data and employment. So in the employment space, there's some plausible data. I will say generally the private data, the alternative data that we look at is better used as a supplement for the underlying governmental data, which is the gold standard. And it won't be as effective as the main course as it would have been as a supplement. So we don't expect that we'd be able to replace the data we're not getting. So I think in job, in employment space, there's some pretty good substitutes, less so in inflation space. And in economic activity space, and also they're just they're different private data providers use different universes and different levels of rigor in their data analysis. So we're looking at lots of things, and we're going to make our decisions according to the FOMC schedule. But I think it will be a lot better once we start getting, for example, the September employment report is going to be a very important report, and we're not on track to have that. There would still be time for us to get that. We will get, of course, the September inflation, the CPI and PPI reports. So that's a positive. But we don't comment on fiscal matters, but from our standpoint, we'll start to miss that data, and particularly the October data. If this goes on for a while, they won't be collecting it, and it could become more challenging.
You used the term gold standard, and you didn't mean it in this context, but I'm going to pivot here because there's a question from the audience that's getting a lot of upvotes. So one of your predecessors, Alan Greenspan, used to view the price of gold as an indicator of inflation risk. So in that context, how do you view the rally that we've seen in gold? And if you want to throw in Bitcoin, you can comment on that too.
I'm not going to comment on any particular asset price, including that one. And I think we think of inflation as driven by fundamental supply and demand factors, and it's not something we look at actively.
Fair. The September projections, we saw revised GDP growth projections revised upward for both 2025 and 2026. Now, sometimes it's just an issue to issue thing, but how do you reconcile that projection of stronger growth with what we're seeing in terms of a likely weakening labor market?
So even subsequent to the September SEP, we've seen economic activity data which are surprising to the upside. And as I mentioned in my remarks, so you do have a bit of a tension there between the labor market data that we see, very low levels of job creation, and yet people are spending. So economic activity is strong, and it's we're going to have to see how that plays out. Right now, of course, we're not getting any new government data on that, any new federal government data on that, but it does create, of course, if economic activity were stronger, then that would tend to support labor market activities and hiring. So we'll have to see how that works out.
Great. Another topic that has permeated the conference over the last 2 days has been AI. So as the Federal Reserve, like all of us, grapple with the implications of generative AI, what plans are in place to assess its long-term impact on productivity, implications for labor markets, and overall economic stability? And does that present any new risks to monetary policy or financial stability?
So you're right. We're doing what other people are doing, which is reading all the things that, so many researchers are working on AI now. It's just amazing. And so we follow all of that. We also have people at the Fed who are doing lots and lots of research on AI. And, in terms of, it's just such early days to be looking for the kind of things that will happen. So, the question of productivity, it was Robert Solow who said that technology is showing up everywhere, but in the productivity data. So this could be the same kind of thing where it's there, but it takes a long time kind of to show itself, because you would think of another big technological advance as potentially raising productivity, but I think it's early to say that we're seeing it. Also, you're seeing, I think some researchers have found effects on hiring from AI for entry-level people and for coders and things like that. So there's probably some of that out there, but it's just so early to say what it will be. We also monitor very carefully what public companies are saying. Increasingly bold statements from mainly large private companies on things that they think they can do across their whole business area with AI, and either sort of freeze hiring where it is or reduce hiring. And I think we're pretty aware of what the potential outcomes are, but the range of potential outcomes is very broad. I will say, in terms of what the Fed can do, we deal with supply and demand. We have interest rate, and we also do regulation, that kind of thing. But if what's needed is greater education and skills, I've always liked the model that technology can work for everybody as long as everybody's getting the skills and aptitudes they need to use that technology. This is Golden and Katz, their work, which they actually spoke about at Jackson Hole this year, but it's a 20-year-old book that they wrote. So we can't do that. That's not something the Fed can do. We also can't address the potential societal disruptions that could happen, potentially, if there's really significant job loss. So there are a lot of, we're the least of it. There are potentially really significant implications for people in the labor force. And I think we're all speculating about what those might be, but it's only the beginning of this story.
Yeah. Looking at some of the other questions that are getting upvoted, and you can get as far into the weeds as you want, but this is where people want to go. So let me try this one. As you think of the appropriate level of reserves in the system, what indicators are most important? Is it the price of money, so repo levels, or the volume of borrowings from the Fed, like the discount window, and so on?
So we have a nice spider chart and 5 main indicators, one of which is sort of repo levels. And I think overall what they're showing is that we're still at ample reserves. Abundant reserves. We're still at abundant reserves, meaning above our goal of ample reserves, a little bit above ample reserves. So But we're beginning to see, you're starting to see a little bit of tightening in money market conditions, particularly repo rates have moved up. And those are the things we're going to be watching. So we think we're still at abundant, and we're, the pace of runoff is now very, very slow. So we're going to be watching all those factors very carefully. And we're not so far away now, but there's a ways to go.
I think we're not going to get away without addressing this one. So I'll try to, again, group some of these together. First, there's definitely appreciation from the audience, your ability to try to remain above the political fray. And I think also, and as in your remarks, you said gradually and predictably, and that sounds really nice right about now. But with that ongoing scrutiny of the policy decisions of the Fed, what measures is the Federal Reserve taking, and are you taking, to ensure and demonstrate the continued independence in setting monetary policy?
So the main thing we can continue to do is to do our work the way we've always done it, which is, think really carefully about evolving economic conditions and the evolving outlook and the balance of risks, and try to make good decisions to best serve, the American public. And then explain those decisions and talk about them in a way that makes sense and is grounded in the data and our overall approach. I think we're going to keep doing that. And as long as we're doing that, people will be able to tell. If we start doing something else, I think people will be able to tell that too. But that's just not something we're ever going to do. We're always going to keep doing our work. We don't engage in back and forth with people. It's just not that gets to be political sort of right away. So we just do our work and do it as best we can. I mean, overall, I would say the Fed comes through the last, if you think about it, go back to the beginning of the global financial crisis. We've had two world historical crises back to back, essentially. And the U.S. economy, it's been quite a ride for the U.S. economy and for American citizens, but we've come through it as well or better than any other country in the world. And we had to innovate and did innovate. There was really no choice. We can look back now and as I did today and second guess ourselves, which is only appropriate. That we've been doing it for 10 years. Since I got to the Fed 12 years ago, we were already doing a lot of that. So that's an ongoing process. But I think if you take a step back, the Fed isn't a government agency that does a good job for the public that it serves, and that is our only goal. And I think we do it pretty well. Don't look for perfection. These are close calls that have to be made in real time. But I guess that's what I would say.
It's fantastic. And in that context, then internally to the FOMC, how important is it that you have consensus on it? I mean, we're economists. We understand the value of spirited debate, but is that important in terms of communicating the results and the decisions of the committee?
I mean, consensus is great, but I mean, the most important thing of all is to get it right. And, that you come to places, not very commonly, but sometimes you come to places where people are going to have different views. And this is one of them. You have a situation here where literally inflation's above target and gently rising. The labor market is subject to pretty clear downside risks. What do you do? How do you think about that? That's not a problem that you face very often in central banking or in the economy. And people are going to have different weights and different risk aversion and different risk appetites on those things. It would be kind of surprising if you had no debate over those things. So we have a healthy debate going. I think it's very healthy. I think the meetings that we've been having are as good as any we've had, in terms of people sincerely, giving their absolute best argument for their positions, but they're different positions. That's, I mean, when I was an investor, I always felt like the most dangerous thing is if everybody agreed on something, because you need someone to come in and try to explain why this is a terrible idea. Hopefully somebody really smart. And that would give you the ability to really test your thinking. So I think that's a healthy discussion that we're having right now. And I'm not at all surprised that we have people across the board. I do think we also, as an institution, do try to come together around a central answer. And that's, of course, part of what I try to do is find an answer that will attract as much support as possible.
Absolutely. I know you probably won't want to comment in great detail on global conditions, but there are a few questions around that and what that implies for U.S. monetary policy, and also just looking at the interest rate differentials between the U.S. and other advanced economies, and how long that could persist, and is there a risk there?
Sorry,
The interest rate differentials between the U.S. and other advanced economies.
yeah, I mean, we set interest rates according to, the place where our economy is domestically, taking into account the international aspects of our economy. So again, it's not surprising. I mean, you could name many, many factors, but, for example, tariffs are clearly more disinflationary for countries that are subjected to them, and they're more, I won't say heavily inflationary, but there's some inflationary pass-through to consumers from countries that are putting tariffs on. So there's a very different monetary policy response potentially just in that. So, I think we need to set, as every other central bank does, they're setting rates in their, whatever their, remit is geographically, and they're going to be different answers. It's not unusual.
So we have a large number of young economists in the audience today. Could you talk a little bit about, as we look back and, it's a momentous award, it's a nice time to reflect. If you looked back on your early career and your early goals, how do you think that young Jerome Powell would view where Jerome Powell is sitting today as chair of the Federal Reserve?
Surprised. No, I would say, so what I would tell young economists is you've chosen a great profession, a tremendous profession. You're getting the tools to analyze public policy and what works and what doesn't work and what should be expected to work and wouldn't and why. And also what's the state of the economy. And guess what? It's not just hard, it's basically impossible, but it's a very, very difficult thing, but it yields itself up over time. And it's just an incredibly important subject that carries the capability to do really good things for the general public, who may not feel great gratitude toward economists, but sometimes. But no, it's really important. You made a great choice, and I would say wish you the best of luck.
Thank you. Agree. Okay, we'll do a little bit of a lightning round here. We have about 5 minutes left, so I'll ask a bunch of questions that you may not want to get into great detail on anyway. Yeah. Some of these are pretty straightforward, but so we talked quite a bit about labor markets, but we have not specifically asked the question about the effect of immigration policies on labor supply. How restrictive do you think that current policy is, and is that something that will just
current immigration policy?
Yeah.
Yes. Let me start by saying that we don't have a view on immigration. It's not our job to have a view. So we take that as completely, it is what it is. We take it as it arrives. More, I'd say, stronger policy than most people had expected. We've seen a very sharp decline in growth of the labor force and in people entering the country, and yeah, I think you're only beginning to see the strength of that policy too. There's more expulsions; those are rising, and that kind of thing. So yeah, that's a big economic factor. So that will mean fewer people to work. You have anecdotal evidence of industries that are just having a hard time finding people. You don't see it in wages or anything like that at this point. You don't see, at least in the aggregate, you don't. But yeah, it's going to be a really important economic fact because that's new people who come into the workforce. They create their supply, but they also create demand. They create their own demand, and again, from our standpoint, we're just our job is to achieve maximum employment or maximum sustainable employment. And that will depend both on the supply of workers and the demand for workers.
Back to the balance sheet, some questions. Again, I'll kind of try to group these together around mortgage-backed securities and housing affordability. Again, not directly part of the dual mandate, but would the Fed ever look at any specific actions with regard to MBS to address mortgage rates or affordability for housing?
The answer is, look, we look at overall inflation and we don't target housing prices. And also I don't know how you would, we would certainly not engage in mortgage-backed security purchases as a way of addressing mortgage rates or housing directly. That's not what we do. We do have, as I mentioned, a very large amount of mortgage-backed securities, and they're running off, but they run off pretty slowly. So.
Fair. Question on the beverage curve. Maybe that's not a lightning round question, but let's try it. So do you think that the shift in the beverage curve is a structural shift or just a blip?
I think it's, you're at a place where, further declines in job openings might very well start to show up in unemployment. You've had this amazing time where you came straight down but I just think you're going to reach a point at which unemployment starts to go up. And we haven't really, we may be hitting that now, but it's been remarkable how that line, it just comes down, 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 down. And which has been, really a great part of the recovery.
All right. Well, we have just a couple minutes left. I think we'll end with maybe another sort of philosophical question. Michael Barr spoke to the policy conference in 2024, I believe it was, and he gave some advice to economists. What would your advice be to the economists in the room in terms of how we can best serve the challenges that are facing us collectively in this moment?
I'm inclined to say, keep your heads up. It's a time when people are challenging expertise, and I think it's a distinguished profession. It's a very high order profession, and you should be proud of your work and keep at it. Ultimately, we're learning about how the economy works and how society works. Our understanding is so basic and so uncertain, really, still after all these years. But, you got to think we're making some progress and doing some good and imposing, sort of an analytical framework around the kind of decisions people make about the economy. So I just want to give you a vote of support and say, keep at it.
And likewise, NABE supports you.
Are we done?
We're done. Thank you so much.
Thank you. Thank you.
What's up, guys? Ooh, I am a weird color. Hmm. Jaundice? What the fuck? Hmm. I guess I'll try that. How you guys doing? I don't remember what your natural skin tone is anymore. Me either. Something like that. Nice, Ben. Thanks again for BTU. Straight vertical since summer. It's really been killing it. I'm actually kind of surprised it's doing so well now because I feel like it should be more impacted by the trade war re-escalating. I survived 2 bear attacks. I would hardly call them bear attacks. Why would KView go to 100? I'd be very happy if it would just go back up. I don't know if we could get through 75.80. It would be very tough. It's not impossible. But I think it would require a fairly significant shift in positioning. And the bears from this level who were here yesterday seem perfectly content just sitting here. Like, I'm not seeing a lot of calls getting, like, sold calls getting pulled back or anything like that. In fact, it looks like they're starting to sell calls in the money a bit. Hmm. Demand for autism pills going up. Did you buy calls at the bottom this morning? No. I had some ES contracts this morning. And I went long at like 66.30. And I'm pretty sure I came within like 5 ticks of getting margin called at the low while I was sleeping. That was a hell of a wick. But I'm up now. I only had like 20,000 in the account, I think. So I came pretty close to just blowing the fuck up. No, it was just one like little futures account. I'd still be alive. Futures are fun until you have to dig out of a hole. Just hedge. You ever go like long ES and then like short 3M MNQ? It's fun. Definitely helps you from getting in too deep of a hole at least. Oh, yeah, it's illegal to use the same instrument to hedge itself. No, 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 no. It's just futures. It's a futures rule. Yeah. I've noticed something interesting about all these like AI deals. It seems like the the initial pump, like after the announcement, is roughly the market cap expectancy of the value. Or perceived value from the OpenAI deal, and then it just bleeds off. So I'm wondering if it's like short term, like a lot of the pump that's occurring in these cyclical, or it's not cyclical. I guess neutral, just neutral transactions. Circular, yeah. Oh, yeah, okay. In these circular transactions, um, I forgot what I was saying entirely. I mean, there isn't any value. So I wonder if it's just like leverage ETFs trying to hedge expected inflows. But yeah, they pump and then it just bleeds back off. Series? It's okay. I I feel like they overcook their pizza a little bit, but it's pretty good. It's not like a destination though. I wouldn't like go out of my way to eat there. What's the next OpenAI deal? I would say probably CoreWeave or um, Dell or oh, what was the fucking stock that we were chasing last year all over the place? The data center infrastructure company. It was like S. Fuck. No, not ARM. Oh, maybe ARM. No, not Snowflake. SMCI. If I had to hazard a guess. Or VRT, maybe? We already have a deal with Microsoft. Ooh, VRT just replaced their CFO. That's usually bearish. You guys want to do some kooky market conspiracy shit? It'll be fun. Yes? All right. Imagine if you started a company where your sole purpose initially is to train people to be CFOs. Then you use your equity stake to force a transition to your candidate. Installing your CFO. Very qualified CFO. Then that CFO finds evidence Hold on, I need to get some drink. Fraud or then they use that evidence to blackmail the board, and gain effective control of the company. Doesn't matter. What do they gain? I don't get the payoff. Control of the company. No, I just felt like mentioning it. I was looking at a stock. Noticed they had a recent CFO change. They don't need to commit fraud. You can just make evidence of it. This is actually bullish and not just a bear market rally. We're not in a bear market, first of all. Not even close. All of the consulting groups and activist investors, it's generally their goal. Activist investors do it through equity stake. Consulting groups do it by supplanting key executives, which is basically corporate espionage. You mentioned yesterday that pump seemed like a bear market rally. No. No, I said a capitulation rally. Or a bear rally, not bear market rally. Bear market rallies are nasty. That's like what we got in April, end of April. Am I reading over Gex right? 70 is supportive, yeah. We slipped it a little bit earlier. Bulls have time to push up, but they need to add a lot more out of the money interest. BMY does look like a good IRA wheeling stock. Oh yeah, I was looking at BMY yesterday. It looked interesting. I like the recent acquisitions. When 2008. Hmm. I don't know. Probably is more CMBS risk compounds. Carry trade's probably pretty sensitive right now, especially given how quickly that risk was gobbled up with no actual change in policy. Yeah, yeah, sorry. Didn't know I still had it off. There we go. You sound like you're not bearish anymore. I mean, I'm not today. Longer term, yeah, still bearish. I don't know. It depends on political shit. The longer term, the longer the better. November 1st is going to be important. It says December 1st. Remember China's approach to pushing back is three-pronged, so it is self-escalating. No, not years. That's way too long for my risk management style. You mean your out of the money weeklies? But November 1st is a Saturday. Get fucked. Who's like an R&B singer? Soul R&B? Like Cisco? No. Well, not exactly. I found an old account with $22 on it. What's the best play for me to turn that into 500 end of year? And purchase a bunch of SPY puts to hedge my SPX calls. Good strategy, or SPY returns aren't enough to hedge. You don't just buy. Oh my god. You don't just buy puts to hedge your calls. That's not hedging. Why does Rims and Tims always type in all caps? Is he related to Trump or something? Maybe. That's how you lose everything on both sides. Yep. Idiots buy calls to hedge your calls. Oh, Jesus Christ. How much money would it take for you to move to Ohio? Where in Ohio? Buying a put doesn't turn your call into a. It doesn't hedge your call. It just creates a long strangle. Or straddle, depending on where you buy it. The things that you want to generally hedge with a directional position are theta and IV crush. So when you buy a put, you're just adding more theta and vega, meaning that you're more exposed to decay and more exposed to volatility going down. So something like a call spread or calendars or diagonals. It's very inefficient. Do we have a full-blown class on this during the next roundtable? No. Equity and index puts are expensive. Like, like systematically, they're more expensive. So you're paying extra for downside convexity. You don't actually need to offset the upside risk on calls. And long options have negative carry. So IV is generally greater than realized. And when you buy long puts, you're increasing the negativity of that carry. Or yeah. Generally, delta is most easily replicated by stock. That's why SPX dealers hedge with ES and MES. Generally, like if you're hedging options with options, you're adding extra Greeks that you don't want, or like Greek values or Greek exposure that you don't want. So like if you have calls on something and you want to hedge the downside, like long call on something, and you want to hedge the downside, you can use a short call, or you can make a collar. I think part of the reason is that we're just floating upward with M2. I mean, we kind of are, yeah. I mean, zero DTs are a lot more binary in their outcomes because the decay is so fast. So generally, something like spreads will at least reduce capital allocation, which is, it is effectively hedging to some degree. Everyone always thinks about it like, oh, I don't want to limit my potential, right? But even if you sell, like, say you think it's going to be like a day where there's like $50 of range, right? And you can get a confirm on either the up or down breakout. Even if you buy the call at the money and sell this one, all the way up here, you're still reducing the cost, and you're still exposed to the probably the maximum value that this contract can get. But you can reduce that. You could be like, well, spot to here is very likely. Here and up is very unlikely. And then, you can open that spread. Like, spreads are great. I don't know why everyone hates them so much. Long options are for scalping generally, and scalping's not the most effective strategy. It's fine if you're very good at risk management and entries, but if you're not, you'll probably lose more money over time trying to scalp than you will make money. Also, people's definition of scalping is weird, which you guys taught me. Thanks. You don't short those calls at the same strike. I mean, you can't. It would just be selling your call. So you're creating a spread. No, McChuggets, if your strategy were actually real and you weren't just fucking off in chat, and your whole goal was to just play the tails, you have no positive carry. So you would need some way to create positive carry on the tails that you're playing in order to ensure that you didn't just lose all the money you put in every day. So the second you change the strike or expiry of the call that you're selling, you've changed the effective payoff structure. Zaref zero. So if you sell calls against longs, you cap upside at whatever the width of the spread is, but you have less vega, less gamma, and less negative decay exposure. So what you're doing is you're monetizing skew. So you improve the carry cost of the position, but you reduce the potential for the upside profitability. You can also do calendars and diagonals where you move the risk across time. So your short call gives you theta to finance the longer position. So basically, if you want better carry, lower vol exposure, and are willing to cap your upside, then verticals and diagonals make more sense. And cap your upside to limit downside exposure. Yeah, basically. But you also you limit other exposure too, right? You're less exposed. We're 66.30, 63.30 end of week in pickles picks. 63.30 is just the next like major downside level after 65.08. 63.60, not 63.30. Which blue line? That's like a major level to confirm correction. There's definitely no reason to think that we're gonna go there quickly, especially with like that's the next level after a loss is 65.08, which we haven't even tested yet. What's today's closing price gonna be? I wouldn't be surprised if it were somewhere around here. It's 2 o'clock right now. Doesn't seem very likely that we're gonna fail 70. At least not meaningfully. Quite a lot of short puts built up there. Failing 70 would be bearish, but I would say we close somewhere between 66.70 and 66.90. And that'll probably trim as we get further towards the end of the day. You could probably just draw fucking lines on this and then like find the find the point where they converge. No problem. Interesting. It's a little weird, but this push up is arguably not as strong as the one that we had overnight. Trump's live with his welfare recipient buddy. I have a huge share position. Let's say I've got a 50% gain, like 3,000 shares. How can I hedge profits from evaporating? But the problem is the cost of the hedge is so expensive. Ooh, so I mean, the simple answer is generally like a collar. That's how you protect your downside while preserving upside. So you usually want like put, you know, X distance from spot and then sell a call slightly further if from spot if you're bullish, or if you think, you know, upside's capped, you can just sell it at spot or above spot. And use the sold call to finance the put, which, you know, can make it zero cost or really low cost. And then you could even go a step further and do what like the JPM fund does, and you can open a like a put spread collar. So like you buy the, you can, and then you can use that to finance an even better put, or to further reduce the cost of the overall collar. And then, or you can, you know, you can do like a calendar collar where you like, you know, use short dated out of the money call selling to continuously finance a longer dated put. Generally when people do that though, they're buying the put at like, they're buying the put in the money to protect downside. So you want to buy like a 0.7 or 0.8 delta put deeper in the money with like a long duration, like 100, like 90 to 180 day DTE. And that's, you know, that's especially if you think of there's like a lot of downside risk present, or, you know, like maybe the company's moving into like a cycle of capex, and, you know, earnings reports are going to be volatile from that point forward, or something like that, or you know, there's some negativity in the guidance, and you think that, you know, either the sector or the company is due for like a larger pullback, but you want to retain your position. You can buy like a deep in the money put and then use like short dated sold calls to continuously finance that over time. You can always hedge with the index. I mean, it's not as good. And then you know, you can like, you could hedge like crash risk, but you know, it doesn't seem like you'd be interested in doing that while you're up 50%. And you know, you can scale your collar relative to your position. So, you know, maybe if you have 3,000 shares, you only sell calls on 1/3 of them. That way you can retain, you know, a greater amount of upside exposure on the other 2,000 shares that wouldn't get assigned. The amount of wealth of knowledge on this stream ranges from masterclass level to Midwest. Sometimes people ask good questions. Sometimes people ask me if they should buy 100% out of the money puts. Do puts cost Sam like calls on stock you own? Sometimes, yeah. My SFX 0p printed hard this morning. This is the Trump era. This is how we talk about percentages from now on. If Pickle Jar could stop giving Sam Altman ideas, a new Salesforce deal has been announced. Walmart's already in bed. Buddy's canvassing. Salesforce also got hacked and gave away a bunch of client data. like this week, so bullish anyway. I need to clip that. There's a lot to digest, but really helpful and dense information. It's hard when I'm not on the same page. Well, I can help you with that a little bit. If you have 3,000 shares of a stock, you can sell up to 30 calls on that underlying at any given time. And so like, wait. Bum, 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 bum. Okay, so let's just pick a random stock. I don't want any of these. Oh, sure, whatever. So let's say you own Tesla and you have 3,000 shares. You're long at it's 211. Okay. Mm, 311. There we go. And you're up 50%, right? So you can sell the like out of the money call, right? Oop, I don't want those linked. That's fine actually. You can sell the out of the money call. You can sell up to 30 of them. Okay. You can use those to buy out of the money puts. Let's say you want to do this for here. And you want to preserve, you know, anything below 420 you want to hedge, or below 400. I guess that's, how far out of the money is that? 400 would be like a 8% drop. Then you get a payout structure that looks like that. At the close. So like, you still preserve your gains if the price of the stock drops, but you're establishing that position for a net credit. So I guess you could even go a little closer to spot, like right there. Like, so you could do like 420, and then if you wanted to even more than that, you're like, okay, well, it's probably not going to go back below like 350. You could sell the 350 put there, right? And you can make $20,000, or well, I guess $20,000 if it stays here, right? So you're capping your upside here at 60% unrealized returns, and you're hedging your downside here at 50% unrealized returns. Right. And so as long as you stay in this range, you'll make $22,000 over the next 38 days. If you fall below that though, you'll continue to make, well, you'll lose zero. And then if you fall below 350, that's when you'll start actually losing money. But if you remove these, or if you exclude those, then you don't lose any more money to the downside after that initial drop below 420. So like you would only lose the share value from spot, so $13 per share, and then everything under 420, you'd be break even. But remember, you're financing this with the sold calls. But by taking extra risk on the further tail, you can increase the amount of capital you get if price stays flat and your hedge dissolves to nothing. So this is kind of give you an idea of like how these work over time. You know, you wouldn't lose any money on your holdings unless it fell below your original cost basis. It's pretty neato. Yeah. So so effectively you're slightly capping upside, but at a level more profitable than you're at now, and you're protecting all of your downside risk, and you're doing it with a positive carry, right? So if that position expires, all of it expires worthless, you make $23,000, which is pretty significant. I mean, 23,000 divided by the value of your holdings, which is like 433.61 times 3,000. 1.3 million, so 22,650. So make like 1.7% yield on your shares for 38 days. That's gonna vary. So effective annual yield. Oh, I did it for the wrong number of days. Hold on. So that'd be like an effective annualized interest rate of like 17.58%. So by using this collar, you've created like a 17.5% dividend on your shareholding, as long as you're correct about the range in which the stock you own trades. That's compounded. I think it'd be like, if you just do simple, it's like 16.3, I think. Someone could double check that, but you could do it all the time as long as you're up on the underlying. Then that's a very effective way to ensure that you reduce downside risk while still leaving some exposure to continued upside. The only way you're turning $1,000 into $200,000 in 5 hours is if you have a extraordinarily large position on something that's doing nothing, and then news drops while you're in that position. Otherwise, that's not happening. I'll be honest, it seems like a better strategy than my normal 200 bips out of the money. You might be onto something, Goric. Yeah? You think so? Yeah, usually insider trading. What if share value continues to go up and you don't want to get assigned? You can just keep rolling your call up. Like if you think something's going to continue to gain value, but you want to gain like downside protection, right? The better way to handle that would be, you buy like 10. So instead of selling like that, you would maybe want to sell like these. right? And then buy like in the money puts up here, maybe, or like 10 of them, right? And then over time, as price rises, this is very, very movable because it's so short dated. You can just keep selling these all the way up, right? So you would, you sell, you want these for, like, say, Jan. I think that's like 90. Yeah, that's 94 days. And then, you could sell like the 450 this week, and then, next week you could sell the 5, or you could even ladder them right off the bat. So you could do like this. Like that, right? And then just keep laddering them over time. And that way, if the stock dumps, you do have some downs. Like, your losses are not going to be equivalent, and until price gets really low. I mean, you gotta go way the fuck out there. But even if like the stock goes to zero, all the way down here, like, you wouldn't start losing money until the share price fell under 213, which, again, that's significantly lower than where you bought the position in the first place. You need a lot of money to do that. Yeah, you'd probably start with fewer, right? If you don't have a lot of upfront capital, you'd start with like one put, right? And then you'd sell these calls, like your ladder of calls. And then, each week, remember, you're gonna roll the lowest one up, the highest one out, and you're gonna just keep collecting that premium as stock prices rise. But if bad news comes along, or you're gonna get fucked, like, this protects your downside significantly. Like, even here with one in the money put, you're protected from realizing any actual loss until the stock price falls under your actual initial buy-in price. If you had 3,000 shares of Tesla, you're probably okay for money. Yeah, that too. I think he's trying to speak more to funding, like using the calls to finance the put. You're not selling any puts, you're selling calls here. Yeah, you just get assigned. But you're still getting assigned at, 10 to 20% more than your current realized gain. You can also roll them up. You don't have to take assignment. No, the put's bought in the money. You sell the calls. You use them to finance the long put over time, which is your downside protection. It works even on a small scale rare. It doesn't have to be. It doesn't have to be like it could be 100 shares of a stock. It could be fucking Fubo. if you want it to be, you know? Thanks for joining, Cornishon, Zaref. I hope that helps, man. Appreciate it. I just opened 30 colors on AQN for 3 cents each. Printing. That's 90 bucks you didn't have before. I don't know. He's doing Q&A with the Argentinians. Oh, Jesus. His bailout buddy.
Into the United States.
He's probably just rambling now.
But I don't blame him. But I'm really angry at Biden and Kamala and that group of lunatics for allowing it to happen, because it's the hardest thing. Now, you know, we're sending them out. It's incredible the job that Christie and Tom Homan and the whole group is doing. But we shouldn't have to be doing that. We're doing a lot of work on getting people out of here. Tren de Aragua has caused tremendous damage, and our soldiers are great. You know, our soldiers are now based on merit. They're not based on woke, because we won the case in the Supreme Court, which was the bravest case. I have such respect for the Supreme Court because of what they did with merit, because our country was built on merit. Countries are destroyed on woke. You know, I made a statement, and I hated to make it because it sounded bad, but everything turns to you know what when it goes woke. You remember the term. I don't like to use it because you might have some children listening, but it turns bad. And no, we have the hottest country right now anywhere in the world. That's why he's here. That's why every other country wants to meet here too. But we only have so many hours in the day and days in the week. But we get the hottest country. Think of it. We were a dead country a year and a half ago. And now we have the hottest country anywhere in the world. It's pretty good. Did a good job. Okay, any other questions?
Would you like to visit Argentina? Would you like to visit Argentina soon? There is an invitation for that.
What does that mean?
Do you like to visit Argentina soon?
I do. I would love to. I'm just a little busy. I would love to. I'd love to go to Argentina. I'd like to be like Biden. I'd like to go to the beach. You know, my legs are not quite as thin as his. My legs are slightly heavier. My arms are slightly larger. My body is a little bit larger than his. I'm not sure it would be appreciated on the beach, but I'm not going to take a chance. You won't see me in a bathing suit. You won't see in a bathing suit sitting on a beach in Argentina, falling down, not being able to lift a 3-ounce chair, meant for old people to lift, and he couldn't lift it, so we had a problem. He spent too much time on a beach. Somebody told him that he looked good in a bathing suit. And you'd see this guy on the beach all the time. I never quite understood it. Steve, go ahead.
Could you preview your meeting with Ukraine President Zelensky on Friday? You expect to talk about weapons? Is there going to be a package?
Interesting meeting going on. Look, I'm very disappointed because Vladimir and I had a very good relationship, probably still do. I don't know why he continues with this war. This war has been so bad for him. He's going into 4 years of a war that he should have won that war in 1 week. He's now going to soon be into his 4th year. He's lost 1.5 million soldiers, probably, close. Certainly in terms of wounded and no legs and no arms and all the things that happen in horrible wars. It's a horrible war. That's the biggest thing that's happened since World War II in terms of death. It's bigger than any of them. I settled 8 of them. The biggest is that in terms of death. Incredible. I think India, Pakistan had great potential too. We did a great job of that one. But he's got to really settle this war. And you know, they have long lines waiting for gasoline in Russia right now, right? They have long lines. Who thought that was going to happen? And all of a sudden his economy is going to collapse. And I'd like to see him do well. I mean, I had a very good relationship with Vladimir Putin, but he just doesn't want to end that war. And I think it's making him look very bad. He could end it. He could end it quickly. And I have to tell you, I give credit because who would think that Ukraine could have fought Russia for 4 years to essentially a standstill? Now, there has been some early, you know, before they knew what the hell was happening, because it happened quick. Biden Should have never let that happen. That's a war that should have never happened, but it did. But it's not making Russia look good, I will tell you that. We'll be talking about Ukraine, yeah. I mean, I have the president coming in on Friday, and I know what he has to say. He wants weapons. He would like to have tomahawks. Everyone else wants tomahawks. And we have a lot of tomahawks. Tomahawk is do you need any tomahawks in Argentina?
You can cross Moscow, tomahawks.
You need them for your opposition, I guess, because see, in this country, they'd use tomahawks for the opposition. I don't do that. I'm much nicer. The Democrats would use them if they had the chance. They're sick people. Go ahead.
President Beams, are you worried that this plan with Argentina can fail?
Anything can fail. Anything can fail. You never know. That's why I say Putin should do something about the war, because so far, I mean, it's turned out to be very bad for him. But anything can, so this plan can fail, sure it can fail, but it's got a better chance, I would say, Scott, it's got a better chance of success than failure. And if it's successful, it's an unbelievable success. It can transform your country into greatness. It's got a great chance. We'd like to give it a chance. Anything can fail, but we'd like to give it a chance. And we think, because he's made so much progress, I mean, the work that he's done over the last 4 years is incredible. And it would be a shame to lose that progress. He's very close to having a big success.
Mr. President, will you consider removing new restrictions on the press that report at the Pentagon? And have you spoken to Secretary Hegseth about this?
I have, yeah. Well, he's finding, I think I can speak for him. I'll let him speak for himself, but I think he finds the press to be very disruptive in terms of world peace and maybe security for our nation. Press is very dishonest. Not you, but the press is very dishonest. Do you have something to say?
Well, I very much appreciate the question, because it was interesting to watch. We had a chance to go along on the historic trip of Middle East peace, which our generation of veterans never dreamed would be possible. So you would think that the Pentagon press corps, of all press corps, would be front and center across the board on wanting to give credit to the president for forging this kind of peace, and instead what they want to talk about is a policy about them, which simply says maybe the policy should look like the White House or other military installations, where you have to wear a badge that identifies that you're press, or you can't just roam anywhere you want. It used to be, Mr. President, the press could go anywhere, pretty much anywhere in the Pentagon, the most classified area in the world. Or also that if they sign on to the credentialing, they're not going to try to get soldiers to break the law by giving them classified information. So it's
Did Trump say it was okay to buy Tylenol again?
Make sure national security is respected, and we're proud of the policy.
You know, we have an option here. As you know, the press years ago moved into the White House. It used to be across the street. We could move them. You're lucky I'm president, because we could move them very easily across the street. They used to be there. They would have more room. We have a beautiful, nice space. You could sit all by yourselves and have fun. Instead, you walk around the White House talking to anybody that can breathe. And, you know, but I find that when it comes to war, and now our great Department of War, we have some great people over there, I think it bothers me to have soldiers and even, you know, high-ranking generals walking around with you guys on their sleeve, asking them, because they can make a mistake, and a mistake can be tragic. They can do it innocently, too. They can, you know, and they're not press people. They don't really deal with the press, so they're not really necessarily good at it, although I think it's mostly instinctual one way or the other. You're either good at things or you're not. But I could see you being bothered by that. And so you have them in an area, and you treat them fairly, but they're not allowed to go into
Much like the
somebody's office and sit with them for 10 hours.
yes, sir.
Yeah, I can understand.
Boston had some street takeovers that we saw. Are you going to work with or try and work with the mayor of Boston? And then they have a World Cup. They have several World Cup games. I know Argentina knows about World Cups. They have several World Cup games. Could those games move to cities that do work with you? Like
We could take them
Washington,
away. I love the people of Boston. I know the games are sold out, but your mayor is not good. They're worse than her. At least she's intelligent. You know, some are extremely low IQ. Those bother me more. She's intelligent, but she's radical left. And they're taking over parts of Boston. That's a pretty big statement, right? We could get them back in about 2 seconds. All she has to do is call us. We'll go in and take them back. but she's afraid to because she thinks it's bad politically. She could take them back too. The Boston police are great. I mean, I know them. They love me. She'll never tell them to go after Trump because they love me and I love them. And I got a tremendous police vote and military vote. You know,
Give me a second, I'll be right back.
all of them. No, I think she is hurting Boston. The answer is yes. If somebody is doing a bad job, and if I feel there's unsafe conditions, I would call Johnny, the head of FIFA, who's phenomenal, and I would say, let's move it to another location. And he would do that. He wouldn't love to do it, but he'd do it. Very easily he'd do it. And this is the right time to do it. If I thought Boston was doing something that was going to cause safety conditions for the World Cup, I could say the same thing for the Olympics, because we have events that are in different locations for the Olympics. It's based in LA. If I thought LA was not going to be prepared properly, I would move it to another location if I had to. On that one, I'd probably have to get a different kind of a permission, but we would do that. Gavin Newsom, he's got to get his act together, because had we not gone in at the beginning of my term, had we not gone in with a very strong, powerful force, they would have lost LA. Now, you already lost 25,000 houses to fires. You got a big scar right in the middle of the city. And that should have never happened, because they should have had the water flowing in from the Pacific Northwest. All they had to do is open up the valves. He didn't want to do it. And he didn't want to do it, he says for environmental reasons. I don't believe that, but for some reason he didn't want to do it. And lost 25,000. You had no water in the fire pumps. You had no water in the sprinkler systems in the ceilings. There were no houses. Normally the things would go in. You might not have lost 2 houses. So if he doesn't play ball, we're going to have to be very tough with him. He's done a bad job. Just to finish off on that, so when we went in, we did a phenomenal job. We went in with great force, and that was the end of it. We put it out. We extinguished that fire, which was agitation, and it was a very dangerous position to be in. And we went and did a great job. But the chief, said we could have never done this without President Trump and without the federal government coming in. Okay, that was it. He said that. Now, 2 or 3 weeks later, he said, we could have done it, but he knows he couldn't. The city was going to be taken over if I didn't go in. And you have to remember that. Los Angeles was going to be taken over. And we have it where the chief said it, I believe, numerous times, but that was as it was happening. That was a rough one. That was nasty. And if we saw a situation like that, we'd be forced to make a move. Boston better clean up their act. That's all I can say. Go ahead. One more question.
Mr. President.
Yeah, please.
Do you feel any urgency to end the shutdown in the next week, 2 weeks, or would you be fine if it stretches into November and then toward the holidays with folks not getting paid?
Well, shutdown, we've had many, many shutdowns, and this is a shutdown that shouldn't have happened. A group of people brilliantly decided to make it after the election. I said, thank you very much. In other words, give it to Trump instead of Biden. So it shouldn't happen. And likewise, debt ceiling shouldn't have. But the great big, beautiful bill solved the debt ceiling problem for.
Is there a point where you would reach out to all parties?
Here's what's happening in the shutdown, though. Honestly, can I put it in plain words for you? And you're a smart guy, so you all understand, but a lot of people don't. The Democrats are getting killed on the shutdown because we're closing up programs that are Democrat programs that we were opposed to. So we're being able, and they're never going to come back in many cases. So we're being able to do things that we were unable to do before. So we're closing up programs that are Democrat programs that we wanted to close up or that we never wanted to happen, and now we're closing them up. And we're not going to let them come back. The Democrats are getting killed. And we're going to have a list of them on Friday, closing up some of the most egregious, socialist, semi-communist, probably not full communist, we're saving that for New York, but semi-communist programs, and we're closing them up. We're not closing up Republican programs because we think they work. So the Democrats are getting killed, but they're not telling the people about that. I say it, I haven't said it probably as bluntly as I just said it, but so we are closing up Democrat programs that we disagree with, and they're never going to open again Thank you very much. Thank you, everybody.
Thanks, guys, right here. Let's go. No. As China deepens its presence in Latin America, what role do you see for the U.S.?
I just like to watch you talk.
Sorry, no? Okay.
Good job.
Okay, thank you.
Good job. Thank you, darling.
I'm here. We dump again? Fuck. That was rough. Yeah, losing 70 really was the end of it. Interesting. We can drop as low as like 30 here still. This could keep selling off. Oh, that's not a good look. I don't know. Bulls are pushing back a little bit, but I don't know if it's going to close at 30. Falling under DN's really, or 50. Falling under DN's really bad. My 10x times 2 on SPX puts today. Thank you for teaching me. That's awesome, dude. Oh, yep, there's 30. That was quick. All right, there's VWAP on ES on the 1 hour. VWAP's at 66.68, which is where that's testing right now. No, I don't think 6600's on the table for end of day. That would be very weird. 6620 maybe is possible. There's a lot of negative gamma down there. Quite a lot. Actually, a little bit more than there is at 6600. Well, I'll say this much. The incentive here for everyone is to try to play the bounce into close. But remember that it's very easy, especially if we fall to 6620, it's very easy to get trapped in the negative gamma. Creates a lot of pinning into close. My name is not Harry Zeldin. Sorry for being in and out all day. I had to do a doctor's appointment and then doctor shit with my mom, for my mom, and then it's been a long morning. How is this not news driven? The last person to say anything was the Feds Collins. It's a nice bounce back. 30-35 support. Trump post, what did he say? Don't forget to get a copy of my son Eric's book, Under Siege. Oh, I see. I believe China purposely not buying our soybeans and causing difficulty for our soybean farmers is an economically hostile act. We are considering terminating business with China having to do with cooking oil and other elements of trade as retribution. As an example, we can easily produce cooking oil ourselves. We don't need to purchase it from China. I mean, yeah, we can. Chicago, what are they, tear gas people? You guys buy Chinese cooking oil? No. No, I don't. You know what I love about this timeline? His merch is produced there after all. Nobody said he was smart. He said smart people don't like him. Are you suggesting the man has miscalculated this approach? Because it sounds like that's what you're suggesting. I'm not suggesting anything. I'm simply stating the facts. Hashtag art of the deal. Did you ever see this crazy shit on fucking MES? What the fuck is that? Yo, why did they cancel that wick? That was weird. Somebody got a 6718 fill on MES on this candle. Or this last candle. It's closing at delta neutral. Gotta love VIX 20. Market's a bit sensitive, isn't it? Yeah, it is. It's my turn to buy some office stacks. Company card, carte blanche. Any suggestions? 100 pack of snack pack pudding is already on my list. Oh, damn, what are they? Do they have to be like individually wrapped? I assume you're going to Costco. You should get a crate of pirate's booty. Some bags of those like beef sticks, the chomps. Peanut butter pretzels. Snacking nuts. Oh, what are those things I buy? Shit. They're like Nature's Bakery fig bars. I assume you want to be promoted and have all your coworkers love you. Actually, instead of Uncrustables, get Bobo's PB&Js. Those things are delicious. Some protein bars with like decent flavors. Tons of nuts. Get like a plant protein instead of whey if you get anything with protein in it. The little squeezy apple sauces, those are good for when people have the poops at work. Buddy works at Bobo's, and I taste tested the PB&Js before they came out. Delicious. Yeah, they're actually really good. What else do I have? I'm trying to think of what snacks I have. Hold on. The Boulder Canyon avocado oil potato chips. The bear what are they called? They're like fruit strips. Those come in like little individual packages. Those are good. Fiber, protein, snacks. They have snack packs of Gardettos. Those are pretty good. Yeah, it's just like fruit leather. I've not had the Power Crunch protein bars, but they look tasty. I might try those. Oh, there's the Universal Bakery Paleo bars. Those are good. You could buy like a big thing of like Danishes or coffee cakes for the mornings. How much are you supposed to spend? Just make sure whatever like protein shit you get is plant protein, and then make sure you get like a good mix of like fruit and carbs and fats. This little son of a bitch. I'm glad I didn't open 70 butterflies. Up to $500 to the 5 of us. Yeah, so everything I said should bring you in around like 200. 250. Most of them are all like $20 a package. Just here, go here. I'll give you a link. Ding ding. It's everything you could ever want. 2-day delivery. If you didn't open 70 butterflies, I didn't open any butterflies. Why does Ivy look like that? Because the market's closed. Alright, let's take a look at end of day here. That was interesting. Like I said, this market's going to stay pretty wild. That's why I'm not making any like kind of predictions or anything, because all of this is just going to be sentimental. The bounce here does give a bit of an inverse head and shoulders off the low of the day. But I don't think it's good that we've like double bottomed and then failed again. And the rhetoric, you know, isn't de-escalating, especially with Trump's with Trump, you know, now pushing, you know, even more trade restrictions. So obviously that was really bad into close. We got a tiny bit of mean reversion there, but still closing red on the day, and NQ taking an even bigger hit on top of that. So I will say that Dow and Russell performed a little better with Jay Powell's speech, not changing the path of Fed rate cuts too much. But this doesn't look great. I mean, it looks like we had a bear flag, it failed, that bounced, and we got a slightly higher high, but that failed also. So I'd be watching the 6680 level in the overnight session, and 6700 to the upside, which we're right in the middle of. Failure there and below the end of day VWAP probably opens up a retest of the prior week close, which we got earlier today as well. The third test of that level, probably not a good thing. Dollar actually dropped a little bit today, finally, after like, you know, it was like 6 days of straight rallying. Gold went up a little bit, silver sold off, copper sold off, and oil sold off back down to $58, which I do think is very low for oil. I would project oil to get up to like 65 a barrel at some point. But if economies keep weakening, especially EU, and potentially growth slowing in the US, then oil may not be done bottoming. However, it is easing price pressures a bit. If oil were higher, the Fed would be far more concerned about things. Once again, we see correlation breaking down after a big push, or dispersion breaking down after a big push into it this morning. correlation on the 1 and 3 month, or the 1 month and 3 month, are not nearly as high as they were at the peak of our drop here. But you know, there is some consolidation going on there in the dispersion trade, and I'm not entirely sure that consolidation is going to see correlation reverse back. Bank earnings were okay, but there were some warnings from JPM about credit risks that might be kind of shaking things up a bit. I know Wells Fargo did significantly better than expected, but not all of them did. And we still have more bank earnings to report for the rest of the week as well. We touched on commodities already. Bond volatility flattened out a bit yesterday because it was closed. But it still looks like there's a ton of demand in the 2 and 5 year in the belly of the curve right now. The 10 year is almost down to 4%. So we're still seeing some flight to safety. It's just not as extreme as it was last Friday. Remember, any announcements moving forward could drive more of that reflexive response. And in line with that reflexive response, as people go longer and longer bonds, they're also going to continue to demand long volatility. And today we have our first close since Friday with a positive forward yield on volatility. And we see the 10-2 has moved up to about 21%. This is starting to be a little bit more durable than our prior moves over the course of the rally into a positive forward yield on volatility. And something notable about this is that the 10-2 curve is moving. Like we're seeing that increase alongside the increase in demand for volatility, and those are the exact conditions that preceded the drop in April. And also in Feb to March, you know, we saw not as obviously not as extreme, but we did see a fairly significant amount of that, both of those yields steepening over time. And then skew bounced a little bit. It's a little bit more downside protection, possibly. Really don't think the turnaround in breadth is very impressive. And we are starting to get more positive correlation between VX and cash VIX, moving up to 51.29%. Remember, just a few days ago, we were like negative 34%. So this is quite a big move in positive correlation, but they're still not well correlated. I mean, they're not where they should be, which is, you know, in the 90% range. So there's quite a bit of room for that to continue to improve. Rate cuts pricing in 64 points by June of next year, 42 by March, and like 1 cut by the end of this year, roughly. I'm pretty sure chances of a October cut right now are still around 90%. And the December cut may have dropped off a little bit over the week. We see the 10-2 steepening by about 3.6% today. And leverage is down. So this is kind of an important chart. This is BTIC on adjusted interest rate and S&P total returns for EFFR futures. Basically, this is a very good measure of like underlying liquidity demand, so demand in individual equities within the index. And you can see that, you know, rises in leverage on that tends to lead to correlated rises in price on SPX. We see leverage falling here, which is also something we see in the options market as well. So both of those, you know, both the options macro side on Gamma Strike and this, kind of pointing at the same thing, which is that there's some risk off going on. I would also say that that's really obvious in BTC as well, which I know many consider to be something that I don't, but I always consider BTC to be, you know, simply dollar leverage. And not only is the increasing risk in the dollar making that less attractive, but risk off in you know, very compressed margin ratios is probably leading to quite a bit of selling in crypto. we retested the 20 MA today, failed it again. We got a little bit closer to testing the 50 MA as well. We closed above the 30, so I mean there's a slight bullish bias on our close, but if the 30 MA were slipped in the overnight, which is around that 66.20 level, I would say that we should be looking at a MA 50 test before the end of this week to the downside, which means a loss of a fairly significant level at 6600, and then our gaze is going to shift out to 6508, which is that August high, before we drop into the trading range from August, which would be pretty significant. There was a lot of leverage and buying packed into the August to September, or August through September move. So there's quite a lot of exposure here, and if that starts, falling off, things could get very ugly very fast. And yeah, so most of the gains today we're seeing we're in finance and retail trade, and we're seeing consumer services and consumer non-durables pick up, process industries, commercial services, communications. Non-energy minerals are still performing well as fears increase over Chinese export controls on rare earth minerals. And so I would say that there's a little bit of an indication that there's some sector shift here, maybe pulling out of tech, backing into financials where there's at least some perceived safety. However, I could see financials getting abandoned pretty quickly as well, especially if the Fed chooses not to cut. McDonald's as a service is funny. They're a real estate company and food distributor, so yeah, they're a service. Most of their money is made providing services to their franchisees, some of which is real estate, the rest of which is food distribution. But yeah, I would argue that that's correctly placed. Yeah, they're definitely not food. They are. They own the majority of their supply chain from the ground up. If you're like a McDonald's franchisee, you source your food from McDonald's. They deliver it in McDonald's trucks from McDonald's warehouses, and you pay, McDonald's premium on having that service rendered. You order your clothes from McDonald's warehouse, like you order your employees' uniforms from McDonald's warehouses. You order your advertising materials from McDonald's. They make toys, yeah. I mean, one would argue before streaming services that Disney wasn't that either. Anyway, yep, that's it. So thank you guys for tuning in. I'll see you bright and early tomorrow. Later.